Stock adjustment strategies. The dual aim on assignment is to be called away, whilst also continuing to receive income through selling covered calls against the assigned stock. Unrealized portfolio losses on assigned stock are paper losses, but represent some level of opportunity cost, as a lesser total amount of premium income can be written against the reduced portfolio value, along with, most likely, taking in lower premiums selling covered calls. Therefore, having an owned stock called away sooner is the preferred outcome. Whatever adjustment strategy used, the intention is to earn income against held stock, whilst being sure to take zero overall intrinsic loss on stock price when eventually called away. When using an adjustment strategy, it's important to keep track of the total dollar amount of intrinsic gain on stock price that's required to get back to break even, whilst also retaining the premium income from the assigned trade. The dollar amount required to get back to stock price break even also shouldn't include any returns from selling covered calls whilst holding the stock. We want to continue banking income whilst owning stock. If it's not possible to write a covered call because the stock price is too far OTM, 1. Wait for price to rise enough to be able to write covered calls. 2. Choose a lower strike. 3. Double down on the stock position. 4. Choose another stock. 1. Waiting for price to rise. We're now a buy and hold investor of the stock. And if unable to write covered calls, that's an opportunity cost for an unknown period of time, which goes against the intention of the wheel strategy, to continuously sell options for regular, consistent income. However, we may have already made near average annual index returns and premium income, and may feel okay holding stock until able to write covered calls and get called away. 2. Writing at a lower strike. If called away at a lower than assigned strike, an intrinsic loss on the stock would be realized. However, there's no reason why a number of such writes can't be placed on the same stock or another to eventually make up the full amount of intrinsic loss each trade, a covered call trade, against purchased stock positions. For example, assigned on a $60 CSP trade, stock price is now $50, unrealized intrinsic loss is $10. Sell a $55 CC. Called away at $55 stock price, now $60 stock price, gain from $50 equals $5. Purchase stock at $60, sell $65 CC. Or buy another stock where a $5 gain on stock price from a CC trade might be made. Called away at $65, realized stock gain equals $5. Result: break even on original stock price loss, plus 2 covered call trade premium. 3. Doubling the position. The stock position could be doubled in quantity by selling high-priced at the money cash secured puts for the same number of contracts as the assigned position. ATM puts may pay 2 or 3 times more CSP premium than OTM. If not put on the second tranche but still unable to write covered calls against the original tranche, another cycle of ATM puts can be sold. If put on the second tranche, we own a double quantity stock position at a reduced cost price basis, with a better chance to write CC against going forward. Whilst the price of an assigned second tranche may seem a good deal compared to the assigned first tranche, we risk catching a falling knife. Stock price could yet fall significantly further, to the extent that it actually may not be possible to write covered calls against the now doubled position. Despite the stock's reduced cost basis, doubling down might best be done when price is at a support level, and could also be done as 2 half trades. When opting to allocate more capital into a single position, being overweight in an underperforming trade significantly increases risk. This adjustment might only be chosen when still having confidence and conviction in the stock, as in nothing fundamental in the business prospects have changed, and also where the double-sized position won't feel like too large a position size of the total portfolio. 4. Changing stocks. This is done to enable covered call writing immediately upon assignment, whenever it's not viable on the currently held stock. Once assigned, it doesn't matter which stock is held, as much as which stock we think price will more likely rise sooner versus the current held stock. That is, choose another stock in which we have equal conviction, but can immediately write covered calls against. The choice of stock is obviously a matter of opinion, which could be right or wrong, which also goes to the point that it actually doesn't matter which stock is held, since it's market majority opinion that will decide whether the original or the replacement stock rises in price sooner. But it does matter that we're able to write covered calls and continue deriving income against whichever stock we currently own immediately upon being assigned. Sell the current stock, realizing an intrinsic loss. Buy another stock, using a similar amount of capital as from the sale of the prior stock. Could be more or less pricey, as long as total profit gain will be pro rata equivalent to the realized dollar loss of the original stock. Write a covered call on the replacement stock at the strike which makes up the required dollar return.